founder, CEO, and chief investment strategist at Mainstay Capital Management. David, what's the messaging for your clients over the last 3+ weeks here with the conflict in Iran?
Good morning, Paul. Yeah, the message to our clients has been, what we would like is turn off the news. Don't become too excited about the headlines. Certainly we're concerned about the war in Iran for good reason, and the escalation of that war in the Middle East with the Gulf states, what that means for oil disruption now that the Straits of Hormuz have been closed, effectively closed. And that's what we're watching and analyzing very close. But what we believe is, not in a matter of days, but in a matter of weeks, the Strait of Hormuz will be reopened. There's already other workarounds like the petro line across Saudi Arabia that moves the oil to the west coast of Saudi Arabia to be offloaded in the Red Sea, and that's 6 to 8 million barrels per day. It's not the 20 million barrels per day going through the Strait of Hormuz, but they'll keep finding those workarounds, and then eventually the strait will be opened, and we'll see oil back off from these lofty levels we're at right now, today even, and stocks will recover, and a lot of other assets. We've had the everything rally. We're having kind of the everything sell off right now. So people are concerned for obvious reasons.
Yeah, well, I mean, and eventually that would happen. But in the meantime, there's a lot of concern, David, about stagflation, a slowing economy, rising inflation. What do you see as the odds for stagflation here?
Yeah, we've been talking about this on the show, and I think what is happening right now are just ingredients for what we've termed stagflation light. Maybe not the stagflation of the 1970s, but a stagflation light, if you will. We have three elements to that. It's a stagnant economy, higher unemployment, higher inflation. And we already know where the labor market is. Labor market is weak and getting weaker. The problem with this escalation in the Middle East is with oil supplies being disrupted, and there'll be ripple-on effects of that for months, even after the straits open. Rising oil prices, energy prices in general are basically a tax on the economy. They're a tax on companies because of their fuel input costs. It's a tax on consumers at the pump. So we have this effect of actually contributing to a slower economy and contributing to inflation. The chance that inflation is higher. And we got a little bit of a scare yesterday with PPI coming in headline year over year at 3.4%, far above expectations and far above prior levels. So, if we see inflation rising, that just makes it tougher for the Fed to address a slowing economy if they need to. And so overall, we have the ingredients for stagflation, even though I know Fed Chair Powell said yesterday we don't, but we do. I beg to differ. We do.
So, David, you're based out there in the heart of America, in Michigan, the great state of Michigan. What's the economic feel in your part of the world there?
Yeah, we're here in God's country, Paul.
Yeah, absolutely.
I mean, this is right. So it is. It really comes down to that K-shaped economy or bifurcated economy. The top 10% are doing well. They're actually making up at this point 50% of consumer spending. And, we have said for 4 decades that, it's about the consumer in our economy. The lower leg of that K, the people that are relying on wages and what we have happening with the labor market, those people are hurting. There's people here that are hurting. So, but it's such a disparity between the upper leg of that K and the K-shaped economy and that lower leg. But the rising grocery prices we've had over the last several years, the rising everyday cost, even in durable goods, it's having an effect.
All right, very good. We appreciate it, as always, David. David Kudla gives us the very unvarnished view of what's happening out there in the marketplace. Founder, CEO, and Chief Investment Strategist at Mainstay Capital Management from the great state of Michigan.